With thousands upon thousands of stocks out there, it's pretty much impossible to get in the weeds researching every single one. So it's best to come up with some quick rules of thumb so you can easily determine whether a stock is worth your time or not. So that's what we're going to be covering in this second module. We're going to look at three key components of business. One is that business's operational efficiency itself. Two, the competitive environment it exists in. And three, the growth prospects of the industry it operates in. Making sure a company checks all three of these boxes will help you separate potential winners from likely underperformers. You can think of it like your analytical litmus test. We'll start with the first component, business strength. For that, we'll use our tool called the GF score. The GF score is a proprietary tool that gives you a comprehensive overview of a stock's overall quality and performance potential. It's made up of 5 subcategories: profitability, growth, financial strength, momentum, and value. It combines years of financial data, valuation metrics, analyst estimates, and more, all to give you a single objective measurement of a company. It's going to be your quickest and easiest way to determine whether or not a company is worth further research. Each subcomponent of the GF score focuses on a different aspect of a company. Each component also has its own individual ranking out of 10, giving you a more detailed look at a company's operations. Financial strength, for example, focuses on things like debt levels and balance sheet resilience. This will give you an idea of a company's overall financial stability and how well they can do things like weather economic downturns. Meanwhile, profitability focuses on things like margins and returns on capital. This will give you an idea of how efficiently a company converts revenues into profits. And then there's the growth category, which looks at a combination of historical and projected future growth rates to give you an idea of the trajectory of the company. Then there's the momentum category, which measures the strength and persistence of a stock's price movement over time, which can give you an idea of the market sentiment and investor confidence around a stock at a given moment. And finally, the GF value rank. This compares a stock's current market price to our assessment of the stock's fair value, giving you an idea of whether that stock is currently fairly priced, overvalued, or undervalued. Putting all of these subcategories together gives you the overarching GF score. Now, that one number doesn't tell you everything, obviously, but it tells you a lot, and it's a great jumping off point. Companies that score above a 90 excelled across all 5 dimensions of the GF score. Companies in the 80 to 90 range are typically very strong candidates with maybe some notable weaknesses here or there. Companies in the 60 to 80 range have potentially meaningful weaknesses, and you ought to have a really good reason for investigating further. And then companies with a GF score below 60 are very likely underperformers. Now, the GF score is such a powerful and convenient tool, we've made it super easy to find and use. You can find a company's GF score at the top of their summary page. You can also add it to your portfolio views. You can screen for companies based off the GF score, and more. You should be able to use it all across the site. So once you've looked at a company's GF score and determined that it merits further investigation, your next question becomes, what's protecting that company's current success? That's where the next stage comes in, a thing called economic moats. An economic moat is a term coined by Warren Buffett, who used it to describe the forces protecting a company from outside competition, like the way a moat protects a castle. The larger a company's moat, the better, because that means it can defend its revenues and profits from outside competition. So let's take a look at some of the major types of competitive advantages, or economic moats. One is called a cost or scale advantage. You can think of companies like Walmart or Amazon, whose massive scale allows them to do things like negotiate better deals with suppliers or operate more efficiently. and price their products lower than their competition. Alternatively, some companies' moats are made up of brand advantages. For that, you can think of companies like Apple or Louis Vuitton. Even though they operate in very competitive industries, they're able to price their products more expensive than a lot of their competition. That's because their brand carries so much value that their customers are willing to pay that premium. Another type of competitive advantage is called network effects. For this, you can think of companies like Facebook or Google that get progressively more valuable the more they grow. For example, the more people that join Facebook, the more valuable Facebook becomes for both the users looking to connect with other people and the advertisers looking to advertise to a large user base. These create self-reinforcing growth cycles. And the last moat we'll touch on for now would be legal or regulatory advantages. For this, you can think of things like patents awarded to pharmaceutical companies. This gives them a significant competitive advantage for a limited period of time. It's really important to identify these competitive advantages because while the GF score helps you determine where a company stands now, the strength of a company's moat gives you an idea of how it'll hold up against future pressures, whether that be competition from other companies or changes in the economy as a whole. The stronger the moat, the higher the outperformance potential. Now, sometimes this can be a little bit tricky to do. Fortunately, Guru Focus takes all of these factors we've just discussed and quantifies them, assigning every company a moat score from 1 to 10, with 10 being the highest. That means by just glancing at any stock summary page, you can get an idea for just how strong that company's moat is. The third pillar of our analytical litmus test has to do with the market forces surrounding a company. That's because even the strongest business models and the widest moats can struggle in a shrinking environment. That means long-term investors need to examine both the company itself and the world around it. If you need more convincing, Warren Buffett, one of the most successful investors of all time, once said, "When a management team with a reputation for brilliance tries to tackle a business with a reputation for poor economics, it's the reputation of the business that remains intact." There are a few key things to look for that can spell trouble for an industry. One, obviously, would be shrinking demand. It's exceptionally challenging for a business to grow when there are fewer and fewer customers for them to sell to. Another one to consider is technological disruptions. If a new technology comes in that upends old business models, that can be exceptionally challenging for legacy companies to navigate. Additionally, regulatory barriers can present a challenge for industries, whether that be by limiting growth or increasing compliance costs. Alternatively, if an industry's barriers to entry are too low, that can create a commoditization in the industry, driving prices and margins down. Healthy industries, on the other hand, show consistent demand and provide opportunities for expansion. This is what you always want to look for, because you want the companies you invest in to be ideally riding tailwinds, not fighting headwinds. Fortunately, Guru Focus makes this super easy. Using our industry overview tool, which you can find under the market data section, you can quickly compare key metrics across industries and sectors to easily identify those that are healthy and expanding versus those in decline.